Okay, welcome to the February 2023 edition of the ASIS Economist Board. I'm John Nelson from M&A, and I'm joined by Keith Prather of Armada. How you doing, Keith?
Doing great. Fantastic, John. Ready to do this.
All right. Today, we're going to discuss the current economic environment as it relates to manufacturing. As I've said in past of our podcasts here, or what do we call them, webinars, our industrial production models incorporate data from approximately 18 to 20 different economic indices, with our data going back over 20 years. We're doing this one on IP-Man and several subsector videos, and we're going to dig into what's driving each of those forecasting models. Keith's also going to help us relate it to what's going on in the real world. So getting ready to launch into industrial production. Keith, you ready to hit it?
I am. You know, we warned folks about this month, so we'll see.
All right. Well, I am going to get this model shared.
We're recording this on a Monday morning, so I just everyone has to hang with us for a minute, right, as we try to shake the cobwebs loose and
you think you're all set to go and you got everything ready, and then oh yeah, I got to do that. So
yeah, there you
go. So here we go. So here's our forecast with the data as of this last month. You can take a look at where we were the month before. The shape of the curve is roughly the same, but it's kind of flattened out a little bit, where we were a little bit on the positive side. Again, not greatly on the positive side in previous months. We were looking to end the 6 months, or I'm sorry, end the 18 months that we project out, somewhere following the top end of that cone. Now we're kind of, no, maybe not so fast. Taking a look at some data that has come in has driven our long-term forecasts out, but the shape still remains pretty much the same, talking a little bit recessionary-ish looking.
Yeah, and what's interesting about this, I always have to get myself, I have to kind of slap myself around a little bit and really look at the curve the way I'm supposed to look at the curve, because I think for you and I always go to the tail end of the curve, right? I look all the way out in like July of 2024 to look and see whether it's moved or not, and then I'm trying to use that to sort of justify what's happening now, and I forget that what's important right now is really the front end of that curve. And you know, we're getting a lot of negative economic reports, if you will, or a lot of negative economic sentiment right now, even in the marketplace. If you listen to Wall Street, I mean, everyone's down, and I always look at the end of the curve and I say, well, hey, it doesn't look too bad. It's like, well, okay, well, that's a year from now. It's 18 months,
a year and a half from now. Yeah.
Right, exactly. So what we're looking at really though is sort of the front end of the prediction curve. And we can see that the blue line, which is the actuals, we continued to decelerate through December. And we're predicting that it continues to decelerate, all the way, really doesn't hit its trough until almost August of this year.
Mm-hmm.
So that is a pretty significant, reduction in activity. And then kind of by Q4, which you would expect, we do start to see a bit of a lift, and you start to see some activity kind of going into the peak retail season. And then it kind of continues that momentum, at least into 2024, but weaker than what we've experienced over the last 12 months or so. So this is, in all, I mean, it looks like it flattens out, but it is telling a sectoral and a macroeconomic mild recession story.
Sure.
And that's kind of what we have to go with right now.
But and you mentioned about how do you look at these curves? Well, if you look at the curve, again, I'd mentioned the first part of the curve looks the same as the month before. That's because the data coming in, what we've observed and what we're seeing in the economy is saying, this is the way it's going to go. When you start pushing out there that 12, 18 months, okay, again, it's what the economy's telling us now is 12, 18 months, but there's a lot that can happen in the world in 12 to 18 months. Heck, peace could break out all over the world in Eastern Europe, or the Chinese could go do something crazy. So when you get out that far, there's a lot of other factors that are going to start weighing into it that we have no visibility on right now.
Yeah, and what's interesting about this too, you think about what the model's looking at. I mean, the model's looking at data that's stretched out over the last 20 years, but really heavily looking at the data over the last 3 to 4 years. And just imagine, I mean, we had the pandemic, you've had a war. I mean, there's just been some incredible things taking place. And, you know, hats off to you, John, because I mean, you do these statistical analysis on these models. And I was just looking over here real quick. I mean, this particular model itself is still hitting 98.8% accuracy 3 months out. And even with all the volatility that we've had, I mean, you think back just, you know, 6 to 12 months ago, I mean, we were starting a war. We weren't even into it yet, really. And, you know, it's still batting almost 90%. So the 6 months out.
Yeah.
So anyway, so we're still really pleased given all the volatility and all the challenges that we've had and the predictability of the model itself. So like you said, that near term 3 to 6 months, I mean, that's what we need to be preparing for.
Yep. And taking a look at the long term, kind of like this chart always, because I think it puts things into that long term perspective. Where are we in terms of how things have looked for 20 years? And a couple things jumped out at me. Wow, there's some big swings. Like that whole time between 2007 and 2010, how far off of the trend line are we the whole time? And then if you look at currently, yeah, okay, we're a little bit off of the trend line, but certainly not all that much. That overall trend line is still the long-term improvement in industrial production, and it seems like we're kind of following that on the way up.
Yeah, I mean, during the pandemic and the Great Recession, we're talking about 20-point swings, 20-point drops. So you're right. I mean, when you and I have talked off camera about this, and you look at that orange curve and what we're talking about with recession, I mean, comparatively, compared to historic numbers, I mean, this would be a soft landing. This is, and let's put it in real business terms, right? This means that companies are still hanging on to some of their best talent when normally they might go through a bit of a layoff period. But in this particular wave, they're cutting costs elsewhere, but they're trimming, they're not trimming that talent they've worked so hard to hang on to, which is also one of the challenges that we've got at a macroeconomic level, because the Federal Reserve is trying to get wage inflation and trying to get overall inflation down. And the more they raise rates, it's just not having an impact on the labor force. And it's because of things like this, where, you know, we're still seeing sluggish demand, but we're not going to see companies go in and just do these wholesale layoffs like we would have gotten in a normal economic curve, which makes them feel different. It makes it not have that sharp, you know, drop. And at least for now, I mean, again, you and I don't have any influence over the model itself. I mean, that's what the model's telling us as a story.
Right. And year over year, it's kind of an interesting story. If you haven't seen these models before, the forecast is that dash red line, and then you see all the other years are represented by the other line. And then we do include October through December of the previous year in the line, so you can kind of catch how it's moving. But it's, you know, that dash red line, that forecast is kind of right there in the middle of all the other years, so I think it kind of puts that a little bit better perspective of where we really are.
Yeah, no, it's a great point. Yeah, looks nothing like the gray line recession curve. So
absolutely.
Yeah.
So let's gonna jump forward. We'll take a look at primary metals. One of the, you know, if we look back into the supply line, what's driving, you know, the model, and you have primary metals. It's kind of got a goofy shape, if you will, but the basic story has remained the same overall in terms of the far out outlook. Relatively flat. I mean, it has a little bit of a curve, but when you're taking a look at, you know, the scale of the model, it's not that much different from last month. We're talking a little bit more of a dip this month, as we were thinking for the next couple months, it's going to drop down a little bit, but then recover right back to where last month's forecast was saying it was going to go.
Yes, I'm going to talk less about the models on this particular one. I want to talk about the market. What we're watching is an interesting scenario, because if you go look at some of the global inventories of certain raw materials, so you look at aluminum, nickel, copper, zinc, all those key metals that go into manufacturing production, right now around the world, if I looked at that historic chart, most of those inventories are going to be at multi-decade lows. Those multi-decade lows of inventories are being hit at a time when a lot of Europe's industrial production is shut down because of the energy crisis. And even though the energy crisis is improving, almost all the purchasing manufacturers indexes, those monthly surveys and measures of manufacturing in those markets, are in recession. They're in contraction levels, and they have been now for 4 to 5 months. So the demand, the consumption of those materials is very weak coming out of most of Europe right now. Also, we got a similar reaction in most of Asia. So you've got significant chunks of Asia that are also seeing contraction in their manufacturing sectors. And you've had China offline now for anywhere from 60 to 90 days, depending on when you put a stake in the ground and say, here's when, the end of their zero COVID policy started. And then they started getting infection waves. And then just like the rest of the world, they go through that infection experience, and absenteeism surged. A lot of plants had to close. And so you don't see the same amount of consumption there as well. So when we look at the marketplace, and I talk to a lot of manufacturers around the country, one of the things that we are watching are things like aluminum supply. And even though manufacturing is down, thank goodness demand is down a little bit, because if it were higher and if we were seeing more demand on the upside, we'd be right back in the inflationary spiral we had at the end of the summer of 2021, where you couldn't get materials. The supply chains had bottlenecks, and we had shutdowns. We didn't have inventories. We ran out of toilet paper, right? Remember those days? If we were back at full global production right now, based on what we see with raw material inventories, these primary metal inputs, we'd be right back in that situation again.
Wow.
So we're hoping during this whole downturn. So when you look at this curve in primary metals, and we look at this softness that goes through July, we have from now until July to get inventories of those raw materials back up at levels where once we see this improvement in demand, that you don't get another surge in price. So right. It's a nasty cycle. And again, if I were seeing those inventories build faster, I wouldn't be as concerned. But I think the war in Ukraine and a lot of challenges that we've got going on in South America right now politically are creating this impact overall on raw material availability.
Right. Well, do you want to talk any more on the detailed charts on this, or do you want to jump over to fabricated metals?
Let's go to fab. Yeah.
Okay. Let's when you get into the fabricated metals, this is also an interesting story. Much like primary metals, it took a little bit of a turn for the worse. For the next 3 months, it's starting to go down. Yeah. Again, in putting this in perspective, you think, okay, you have industrial production, you have primary metals on the far end, and you got fabricated metals kind of like right in between, feeding into the rest of industrial production in the supply line. And you can see how primary metals is probably playing a big role in driving this down as well.
Yeah, it is. And this particular industry also is driven by all the others. So not to try and pump the other models, but subscribers get access to our aerospace, automotive, machinery, computers and electronics, electronic equipment and appliances, all those other models. And you can see the weakness in some of those models driving the weakness in fab metals. Because again, you've got the fabricated metal, industry now feeding into all those other sectors, and just this downturn is actually pretty dramatic. Like you've said many times, John, this one was actually more dramatic, because if you look at the bottom end of the previous curve, if we look at that model, we're actually below that. So this model this month is reading a significant downturn in overall demand, more so than maybe we see in other models. So this one spooked us a little bit, and I'm not sure. You run most of the data, so I don't know if this is one of those that made you do a double take, and you had to go back and look and make sure you didn't transpose a number or something. But it almost has that feel to it, like something's wrong, Yeah,
and this one did, just like primary metal, maybe do a little bit of a double take. What we've seen sometimes in the past, particularly with some of these more volatile sectors, is I've used the analogy of kind of a whip, where it's whipping around a little bit until the market settles down, and then for several months it'll play nice. But right now we're getting that whip effect that's certainly towards the tail end.
Yeah, well, and look at the next slide, because it's it really starts to tell that story.
Yeah,
you look at.
Go ahead. Yeah.
Two gentlemen. Yeah. So it doesn't. Again, it's not as dramatic and as deep maybe as we had in the Great Recession. in 2008, 2009, but you're still talking about a pretty significant downturn. And what maybe bothers me a little bit more than maybe some of the other curves is we're not getting that rebound in 2024. So remember, as we said, just a couple minutes ago, I mean, this goes out 18 months. So you're talking about the end of 2024, and this part of the industry is not yet out of recession.
Right.
And so that's what stunned me a little bit of not getting that recovery, not getting that rebound yet. Now, I think you've said many times, this is a volatile industry. You can see the movements here.
Yeah, you can see that this movement looks a lot like the movement from 2014 through 2017, the summer of 2017. So there is kind of the slope in terms of scale, but yeah, there's no rebound on this one as of right now.
Yeah, I mean, the model's still looking for a bottom on this one, which is a little worrisome. And if you look at the previous cycles, like from trough to peak, you're kind of looking at maybe 4 years between 2016 and about, the late 2019 period.
Right.
So 3 to 4 year cycles here. And so we hope that little tiny blip that we see here is maybe the trough for this particular cycle. If the model doesn't adjust itself, I mean, there is that one, you can see it kind of fighting with itself a little bit as it goes into, kind of mid-year in 2023, but then it's reading something that gives it that second leg downturn. So I don't know, future models, we may get a little bit of an improvement here, but again, this one's going to depend on, what happens with aerospace and automotive and some of those other sectors, machinery especially. So
Sure. Okay, well, that concludes our look at industrial production and the two primary feeders, primary metals and fabricated metals. We hope you've enjoyed it, and I hope you join us again next time.
Yes, I'll put a real quick plug in. So if you're just watching this as part of our, just what we post to the public, be sure to get a free trial to the ASIS and go check out all the other subsectors during your trial. Trial period 60 days. No harm, no foul, just goes away after 60 days if you do nothing. But go check it out and look at the other models that we have, check out the reports and take a look at what story we're getting from at least, the models thus far. So appreciate it, everybody. Take care.
All right, take care.